Hey, welcome back. And in today's video, we're going to talk about Dutch Bros and four specific points that I want to discuss on Dutch Bros, being their shop growth, the recent news of their dilution for that shop growth, the profitability, and the culture. So with that being said, let's get right into it. Now, to give people a quick introduction as to what Dutch Bros is, it's basically just a fast-growing coffee stand that's been in business for about the past decade or two, but has gotten more serious about their growth as of recently and has brought in new management. And many people think, oh, it could be the next Starbucks. So let's really see, and let's go into the first point, their shop growth. Now, Dutch Bros has publicly stated that their long-term goal is over 4,000 stores by around 2030. And so this is just what we have over the course of Q2 2022 to the second quarter of 2023. And as we can see, they've opened over 151 shops, 137 of those being company-operated ones and not franchised. So although their store growth is growing at a 25% rate, they're really growing their company-operated stores at a 41% rate, which is an important distinction because, as we'll see later with their profitability, their franchise stores tend to be less profitable than their company or operated ones. And that's why they're choosing to go with this more company operated version, because they can do it faster and more profitably. Now, going hand in hand with their shop growth is also their revenue growth. And as we can see, their revenue growth from their franchised went from 26 million only to 29 million, while their company operated growth went from 161 million to 221 million, representing a 38% growth in their company operated stores and 34% over all their stores. Now, their new stores contribute significantly to their increased revenue, which we saw was at 34% year over year, while their store count growth only went up by 25% in total. So there's around a 14% difference in the revenue generated from their new additions of stores, which also means that they must be growing their same store sales by at least some amount. Now, although we notice that 14% difference, we can see that their same shop sales versus the prior year seem to be somewhat flat at 3.8%. And we've seen in the past that it's somewhat cyclical in nature, where we have negative quarters and then 10.1% quarters and 7, 9, 6, 8. And so it seems to be somewhat sporadic. But even if it stays flat and all of these stores continue to open and they continue to expand over 4,000 stores, we can still see significant upside in stock. It may also be important to note, if you're going to compare this to one of their competitors, like Starbucks, let's say, their same-store sales growth is in the range of 10 to 11%, at least over the past 2 quarters. And although these numbers are a little skewed heavily towards their international markets, as the US markets are pretty mature at this point, it's still an important metric to keep up with as you invest in Dutch Bros or even Starbucks or pretty much any retailer going forward. And Dutch Bros could do many things to increase their same-store sales, whether that's introducing new items, maybe food items that people want to get alongside their coffee. All of these things can contribute to increase same-store sales growth and drive their revenue and potentially profit even higher. Now, moving on to the second point, which was around their dilution recently of the stock in order to raise money for the company. We saw that they announced a $300 million stock offering, which represents nearly a 5 to 6% dilution to current shareholders, and the stock dropped around 7% after hours on the initial news. It's rebounded a little bit, but this drop in share price due to the dilution seems pretty typical for the market. But I believe, as a more fundamental investor really looking at the business, that these people who are judging it that way are looking at it in the wrong way and thinking about it in the wrong way. If they're able to use that $300 million to open up new stores or even increase same-store sales revenue, this could prove to be pretty accretive to shareholders. You have to also consider that the only other option for them to raise money like this would be to have to go out to a bank and go get a loan. And with interest rates so high, they could be paying upwards of 7, 8, even 9, 10% to a bank when they could just dilute their shareholders in the short term and end up driving a lot of value by opening up these new stores and expanding. Now, you have to believe that this business model is going to work all the way up to that 4,000, 3,000, heck, 10,000 stores to think that this might be accretive to shareholders, because you are getting diluted a fair amount. But if you do believe that, then it should be somewhat of a no-brainer to raise as much capital as you can and then just deploy that and open up all these stores and just skyrocket that revenue way higher than the dilution would even amount to. Now, I am no fan of companies diluting their shareholders like this, but at the end of the day, if they're able to achieve a higher return than the amount that they diluted their shareholders, it's kind of a no-brainer for them to do this. Now, moving on to the third point, their profitability. It's all great that they can grow their stores infinitely, hypothetically, but if they're not being profitable, then it's really not going to be a good investment regardless. So let's dive in and see how profitable they actually are. Now, although Dutch Bros has been around since the 90s, they have just now become profitable as a public company right around the past few quarters. And over the trailing 12 months, they have grown profits by $25 million, which represents an over 100% gain, demonstrating their ability to at least generate some meaningful value from their existing locations. This trend is very telling, as it will show how much they're able to actually earn as a percentage of their revenue in the long term. And in a time period where interest rates are high and investors are really looking for profitable companies, this is a really important thing to look at. And if they can continue to keep growing at this 103% rate, which they won't, they'll slow down. But if they're able to keep it at least 20, 30, 10, I mean, who knows where that number really lands? But as long as it's consistently going up and their store revenues are going up and there's a clear like gross margin that we can see how much money they're actually making, we will be able to predict an actual value for this company going forward when we have these more consistent patterns, when they've grown those locations to where their sales and marketing aren't as high and their fixed expenses aren't as big of a cost on this company. Now, the last point I'll make on this company is their culture. And one of the qualities that I find most attractive about Dutch Bros is the culture and the customer service that I believe differentiates it from Starbucks. If you live within the United States and you've ever been to a Dutch Bros, you will know that the baristas are typically pretty friendly and chatty. Sometimes to the point where it's kind of annoying, but for most people, it's pretty nice. And while the same could not be said for other big chains like Dunkin' Donuts or Starbucks. Now, I also believe that this difference in culture is part of their competitive advantage because it can build somewhat of a fondness for the brand that I have personally seen but don't witness with other brands like Starbucks or Dunkin' Donuts. For example, you see a lot of people who love the taste of Starbucks and the products that they have, but you don't often hear them talking about how much they love the server or the barista. Oftentimes you just hear how they got your name wrong. But with Dutch Bros, a lot of people say that, oh, they just have a really nice vibe. They have a very specific Oregon-friendly, beachy, hippie type of vibe. And to a lot of people, that's really attractive. And I'm sure that they could kind of change this a little bit into where it's not so much just Oregon coastline type culture, but even Southern culture within Texas, which is one of their biggest markets actually, even though they started within Oregon and in Washington and California. And expanding even further on that point, I think that many customers, especially younger women, love the experience of the small coffee stand with the friendly barista rather than the more corporate-like Starbucks, where it's just not the same experience. And I think if a company is able to give that small stand type of feeling while also having a consistent product across many, many stores that people can rely on and guarantee, like Starbucks, if they can mesh those two together, it can be a really promising investment because if they're able to treat their customers so correctly and so right and really satisfy them, then the profits will follow in the long term. Now, in conclusion, Dutch Bros is a promising company with a lot of potential in its future. They have a strong culture, a new CEO, good brand recognition, and they're in a lot of major markets. But they also have plenty of room to expand into other ones on the East Coast, more on the West Coast, and throughout the center of the United States. And who knows, maybe even one day internationally. But I think it's important to note that they're still not very profitable. They have a lot of competition within Starbucks, Dunkin' Donuts, and many other coffee companies and quick access food like McDonald's and who knows what. But at these prices, I do think that there is a long-term story to be had here where their profits can continue to grow with their store count and their revenue, which will ultimately reward the shareholder in the long term. Thank you for watching. That's all I had. Let me know what you think in the comments section down below, and I'll see you in the next one.